Diagram 21, rentals, installment credit agreements and leases. So what I just want to do with you first is I need you to understand that there's two types of transactions that we're looking for here. In financial accounting, many people will have done leases before, and the two types of leases: a finance lease and then also an operating lease. It's a little bit like that over here, but the laws are a little bit different from accounts, and even with the income tax legislation, there's different ways of treating leases and installment credit agreements. But from a VAT perspective, installment credit agreements and finance leases are treated the same, and that's the first thing that I just want you to understand. So in tax, in the Income Tax Act, and in financial accounting, okay, we look at the way we need to actually treat these things. The VAT treatment on a finance lease and installment credit agreement, identical. So it doesn't matter whether it's an installment credit agreement or whether it's a finance lease, treated the same. Okay. If it is not an installment credit agreement, then it is treated as a rental agreement. So what is a rental agreement? It's anything that's not, in terms of the VAT Act, an installment credit agreement. So a finance lease is recorded under the term installment credit agreement in the VAT Act itself. So what happens when there's a finance lease? So generally, if you're a postgrad student, they might ask you whether it is a rental agreement or an installment credit agreement. And what you basically need to do is you need to actually just physically understand that. You need to open up your cycle legislation handbooks. And what are you going to do with that? There's a definition of installment credit agreement in Section 1 of the Act. And what do? You go through the requirements that are inside the Section 1 of the Act. As an undergrad type student, generally, not in that much detail. Often you're not allowed to take your books into your exams. Okay, so it's unlikely that you're going to be asked for that amount of detail without a book itself. The moment you know it's an installment credit agreement, if you guys have tagged properly, Section 10.6 says that you need to use the cash value of that supply. And Section 9.3c says it's the time the goods are delivered or the time of payments of consideration, whichever is earlier. So you can actually highlight this in your books if you're a postgrad student. And you'll know how to deal with a finance lease or an installment credit. So people say to me, why do they say cash value of that supply? Well, if it's a finance lease, you're not actually buying it. There's no invoice. So you need some way of actually being able to determine what the value is that you're going to levy VAT on. So VAT is levied up front on the cash value of that supply. So that's why we've got here. Value of supply rules. Lease does not have a selling price, as the legal form of the agreement is not a sale. Value of supply will be the cash value that the item could be sold for. It's fair market value. Time of supply rules. It's the earlier of time of delivery or time payment is received. Now, anything that is not an installment credit agreement gets treated as a rental agreement. And what's the value of supply rule? It's the amount that's on the invoice. It's a rental agreement. There's a monthly invoice for use of the asset. Whatever that amount is the amount of the VAT, and when? It's earlier of, when payment is due, when payment is made for rental agreements. So just think about it. If it's a finance lease or an installment credit, it's as if you bought the asset up front. You get to claim all the VAT up front. With a rental agreement, the VAT is on the monthly invoice itself. So here's a decision analysis for leases over here. So let's just make sure we understand. So the first thing you've got to do is you've got to see, is it an installment credit agreement or is it a rental agreement? Okay. So rental agreements, monthly, or however often the invoice is issued. And installment credit agreements, finance, lease, hire, purchase, suspensive sale, installment credit. Okay. What's going to happen? All the VAT up front. Now, if there's input VAT denied when you get it, just remember, input VAT denied, you do not get to claim for motor cars or entertainment assets whenever input VAT is denied. And that applies equally for a rental agreement as it does for an installment credit agreement. So The section doesn't override those input VAT denied sections. Input VAT will be denied. But if it's a rental agreement and it's not a car entertainment asset, you claim VAT on each lease installment. There'll be an invoice. The invoice says $1,500, and what are you going to claim? Times 15 over 115. For an installment credit agreement or finance lease, you do not claim VAT on the individual payments. What do you claim VAT on? The open market value times 15 over 115 when earlier of the date of payment or when the goods are delivered. So what I'd like you to do now is just have a look at this page. Make sure you understand this page. Pause this video now. When you're ready to continue, we will continue with some examples on the next page. Pause now. So let's start with some illustrations. It says a machine is leased out by Limited, the monthly VAT vendor, with payments of 30,000 Rand a month over 60 months. The cash value on sale was 1.5 million, including VAT. Should payments not be made, the lessor will recover the property. However, once the final payment is made, ownership will be transferred to the lessee. The lessee has a duty to maintain the machine. The lease was signed on 24 March, but the machine was delivered on 4 April, and the first payment took place on 1 May. Okay, and it says briefly discuss the VAT implications for the above. So what I want to do is I just want to treat this as a little bit of a exercise on what you might have to do in an exam. So normally if you're a postgrad student, you're allowed to take your cycle legislation handbooks into the exam. So what you need to do is you need to open up on section 1 of the Act and look for the definition of installment credits and have a look to see what's included in there. And that's what I'd like you to do now. Go get your legislation handbook if you do have one, and go have a look at what the definition of an installment credit agreement is. Pause this video now when you have looked at that definition. So having looked at the definition, there's a whole lot of stuff in there. And what's included in there is, are the installments more than the value of the asset itself? Is interest built into it? Does the lessee have the duty to maintain the asset itself? Ownership is transferred to the lessee at the end. Now, if the way that it is described in the definition of an installment credit agreement applies, and that does apply over here, it says here, this is treated as an installment credit agreement as payments made with interest built in, and the aggregate of all the payments is greater than the cash value of the asset, and goods are returned in the event of non-payment, and the lessee has to maintain the machine. All of those indicates an installment credit agreement. So you will use the definition and say, this is an installment credit agreement. Okay? And what's going to happen the moment it's an installment credit agreement? Guys, this is a lease. There's no invoice that's got the value of the asset on it because it's a lease. So what do? The Act says we need to use the cash value to determine the VAT amount, and because it's an installment credit agreement, it's on the full cash value times 15 over 115. And what was the rule? Again, if you are allowed to take it in, you will have it tagged, cash value, time the goods are delivered, or the time of payments of consideration, whichever time is earlier. So earlier of delivery or payment. So let's go back and have a look. It is going to be delivered on, where was it, 4 April. First payment 1 May, the earlier of the two is 4 April, and that is where we are going to be able to claim for something. So from the lessor's perspective, output VAT of 1.5 million, open cash value times 15 over 115 will be accounted for. Earlier of delivery or when first payment is received, 4 April. So earlier of the two, therefore, goes into the VAT return that 4 April goes into. It says, would the VAT treatment change if this were an installment credit agreement rather than a finance lease? So I'd like you to think about that. Now the answer to that's no, it wouldn't change. Because installment credit agreements and finance leases are treated exactly the same way for VAT purposes. So no, VAT treatment would be absolutely identical. There it is. That treatment would be identical. Next one. It says, would the VAT treatment change if this machine had an open market value of 5 million and would be returned to the lessor at the end of the agreement? Well, then it wouldn't be an installment credit agreement. Okay? The payments wouldn't exceed the open market value of supply. The lessee would not get the asset at the end of the life of the lease agreement. And that would indicate a rental agreement. So yes, most definitely the VAT treatment would change. And how would it change? Well, earlier on in the question, it says it's a monthly payment of 30,000 a month. So what would you do? You'd claim input VAT on the VAT payment not the VAT payment, the lease payments each and every single month, because it is a rental agreement, and that's what we do. We claim it on the amount paid each month of the invoice with rental agreements. So, number one, it's an installment credit agreement. It's as if we sold the asset, so all the VAT gets claimed up front based on the open market value. When it's a rental agreement, it's on the monthly payment that needs to go through. That's how you would claim it. It says, would the VAT treatment differ if the asset was a motor car, as defined, rather than a machine? Absolutely. What happens with motor cars? Input VAT is denied on the acquisition of a motor car. And because input VAT is denied, you cannot claim the input VAT. The lessor would still charge output VAT. Because remember, input VAT is denied. Output VAT still needs to be charged. So the lessor would charge the output VAT. The lessee could not claim any VAT because input VAT is denied on cars. So there it is. No VAT claimed by the lessee, input VAT denied. Lessor would still charge output VAT. Number 5. What would the VAT treatment be if the monthly finance lease payments of the monthly finance lease payments on the machine So guys, with a finance lease, do you understand that all the VAT gets claimed up front? Because all the VAT is claimed up front, you don't get to claim on the monthly installments. So it says here, as the VAT has been claimed, charged up front, there's no VAT levied on the monthly installments. So finance lease or installment credit agreement or suspensive sale or HP agreement, whichever way you want to actually call it, they all got the same basic way that they are actually structured as a contract. VAT upfront, no VAT on the lease installment. If it is a rental agreement, you claim VAT on each of the installments, except if it's a motor car or an entertainment asset. Moving on. Illustrative example, rental agreements itself. So again, what I'm going to do is I'm going to give you a chance to think through a solution before we go through it. So it says, for each of the following, calculate the amount of VAT input that may be claimed, and in which month the VAT will be accounted for VAT purposes. Assume all parties are VAT vendors unless otherwise stated. So number 1, it says a motor car was leased in terms of a rental agreement for 5,000 Rand a month. So think about what you're going to do. It is a rental agreement, so it is done monthly, but this is a motor car, so input VAT is denied. So the lessor would charge output, but the lessee would not be able to claim input because it's a motor car as defined. So it says no input VAT can be claimed by the lessee, as this is for the supply of a motor car as defined, upon which VAT input is denied. VAT will still be charged by the lessor. Let's look at the next one. A fax machine leased in terms of a rental agreement for 575 Rand a month. What would you do with that? So it's a rental agreement. What's going to happen? That means that we get charged VAT on each of the individual payments. It is a fax machine, which means that it's not used for entertainment or for as a motor car. Therefore, what can we do? It's a rental agreement. We're going to claim VAT monthly on the monthly lease charge. Here it is. Next one. A microwave for the staff kitchen was leased in terms of a rental agreement for 115 a month. Guys, it's a rental agreement. Microwave for a staff kitchen is entertainment as defined. With entertainment, input VAT is denied. So once again, the lessor will charge output VAT, but the lessee cannot claim the input VAT because it is being used for entertainment, the provision of food and beverages, warming up those food and beverages as defined. Next one. It says monthly rental for offices was 23,000 Rand. So what's going to happen with the monthly rental for offices? Guys, monthly rental for offices, okay, is a rental agreement. It's not a finance lease. You're not buying the offices themselves. Can we claim VAT on rent? There's no input VAT denied on it. So the lessor will charge output VAT, 23,000 times 15 over 115. That will charge 3,000 Rand output. And what can we do? We can claim the input when we pay it. And the last one, factory rental. It says monthly rental for the factory is 17,250. The owner of the factory is not a VAT vendor. So what happens if the owner is not a VAT vendor, guys? You are not going to get a VAT invoice. And this is not the acquisition of a second-hand good. So notional input VAT can be claimed. This is the rental charge. No VAT invoice from the lessor. You cannot claim VAT input on your side because you are not paying any VAT to the lessor itself. Therefore, no output VAT charged. No input VAT may be claimed.